Okay, well, this lecture is actually going to be fairly short because creating a budget is more of an application. You have to see it, and I would say if you really want to understand how to put a budget together, I've done that with the looking at the individual problems for this chapter. So look at that, and that'll kind of show you the various pieces that go into building a budget. So the lecture is going to be fairly short, and we're going to kind of confine it to more general topics, not get into specifics. Again, the specifics are in the homework lecture, if you will, that I put on YouTube on Moodle. Now, first of all, what we're looking at is the master budget, which is the quantitative plan for a company for the upcoming year. Good companies will plan. They will have a strategic plan, which is looking at what they think that they're going to do, their opportunities and threats, strengths and weaknesses over the next 3 to 5 years. The master budget is, okay, given that, what are we going to do next year? And more so, the master budget actually puts numbers to it. And everything that the master budget is based on anticipated sales. So everything is going to be a function of what they think they can sell during the upcoming period. But the master budget must always be in sync with the strategic plan. Now, why budget? Well, one, it gives directions, communication, goals are being communicated to various people throughout the organization. Hey, this is what you have to do to achieve this. I know what I need to do to be successful, to get a promotion, etc. And we can essentially audit performance. If you were told that sales are going to be this, you didn't achieve it, or given that level of sales, we have to produce so many units, we'll find were we able to produce it. Okay? So again, we're putting a lot of numbers here. At some point, strategic plans are very general, much more verbal, but at some point, you need to have something has to be reduced down to numbers. And that is, we need to be able to measure what we're doing, and we need to be able to measure, did we achieve that or not? Rather than saying, oh, well, I feel good about it, okay? Well, did we get it or did we not? And again, it helps motivate people. If I know that I have to achieve a certain level, then I'm going to do what I can to achieve that level. Okay. Now, we're not going to get a huge, eventually you're going to have to take a class in strategic planning, but again, strategic plans and operating plans go hand in hand, but overarching, the number one priority is the strategic plan, which needs to be kind of modified, looked at periodically based on what's happening in the environment with the company. And the operational plan, namely the master budget, flows from that. Okay, so if you say, okay, we want to be the number one seller of our particular product, then the operational plan, the master budget may say, okay, we want to increase sales by 5% this year. Okay, that's going to be our goal. And then based on that level of sales, how many units do I have to produce? Excuse me. How much direct materials do I need to purchase? How much labor do we need to have? What about all the indirect costs? Are we going to be able to get that? So again, things filter down from strategic down to operational. Strategic tends to be very general. Operational master budget tend to be very, very specific. And yes, there are some things in between there where you can put some numbers and things to it. Okay. The budget cycle, that is the budget, needs to be created before the fiscal year. And so there needs to be a degree of prediction. Marketing people are going to have to give you a prediction about what they think costs are going to be, or excuse me, what they think sales are going to be, given the level, what the goals are of the strategic plan. And so given that, then we can build the budget based on that anticipated level of sales. Okay. Now again, the subordinate, okay, those below executive level are given a specific objective to achieve, and because it's been reduced down to numbers, they'll know very clearly whether they achieved it or not. And likewise, at the end of the year, we can investigate any deviations, any variances from that amount that was budgeted, both on the positive and negative side. Okay, so we're looking at the master budget, what's going to happen during the next year. So now we're talking about, not rather strategic decisions, we're talking about operating decisions. Okay, That is, we have limited resources, a limited amount of cash. How do we best utilize that to achieve our strategic plan? And again, there are going to be some difficult decisions that companies have to make. How do we employ our labor? How do we employ our cash? How do we employ our capital assets? Do we want to go after this market? Do we not want to go after that market? Okay. And so these are going to be looking at that aspect of it. But the other thing the master budget is going to make you do is, how do we pay for it? I mean, that's an important element of that. You can have the strategic plan, but at some point, the company's got to be able to pay for what it wants to achieve. Again, these are all of the advantages. Conceptual promotes coordination, communication, judging, performance, motivation, also the general benefits of having a very specific budget. Again, what is a benefit can also be a very challenging thing. One, upper management has to support the creation of the budget, and they likewise have to be very serious about it. And the goals of the budget have to be challenging, but not too challenging. If they're too challenging, if people perceive it as being impossible, they give up. If it's perceived as being very easy, people laugh at it. So it's got to be, you got to find that happy spot in between here. And likewise, too, managers can look at from period to period, from month to month, from quarter to quarter, set sort of intermediate goals and decide whether we're working actually towards achieving our overall master budget goal. If not, they can take some corrective action during the fiscal year. Again, generally, what we're going to look at is a master budget of 1 year. Now, excuse me, a rolling budget would be one where I'm going to kind of revise the budget every quarter. So I will kind of create a new budget at the end of each quarter based on new information. This is kind of expensive and time consuming. Generally, companies don't do it unless they're in a very turbulent, challenging environment where things are changing continuously. So because of that, they may have to kind of revise some of the estimates that they made in their original budget estimate. Okay, just some general concepts here. To prepare a budget, you have to obtain some information, particularly marketing. I need to get some information about labor costs. I need to get some information about the cost of my materials, both for direct materials, indirect materials. I may need to get some decisions about if we have to expand production, what's going to be the cost of new machines, what's going to be the cost of new land, building, whatever the case may be. Depending upon how the strategic plan is moving me, I may have to make some decisions about, well, maybe we want to choose this material or choose this. Okay? And then I need to implement it. Okay? I have to do it at some point. It's not enough just the plan, but we actually have to do it. All right. You can look in your text and others. You can kind of look through these steps here, okay? But the first step is always the most important, and that is we need to prepare the revenue budget, which is going to be the predicted sales of units times the predicted sales price. Again, those are all both predictions. Okay, the budget is going to be based on my sales, that is what's flowing out of finished goods, plus or minus what I have as beginning and ending inventory. So my production may be greater if I want to end with more ending inventory. My production may be less than sales if I want to end with less ending inventory. So my ending inventory may be sort of anticipation of what I think might happen next period. I'm going to have to budget for materials. I'm going to have to budget for labor. And again, these are all very specified in the problems. And I think rather than making a big deal of this, I will direct you towards looking at the problem of how you go about preparing this budget. Budgeting is doing, it's not about thinking, okay? Yes, there are some general concepts to it, and that's kind of what we're talking about here. But when it comes down to it, you have to prepare a budget. And I think the best way to learn budgeting is to kind of see an example of it. Okay. And again, these are all the parts that I'm building, okay? From the overhead, the inventories, okay, the cost of goods sold. All right, well, okay, at some point, I want to prepare what's called a pro forma or a budgeted income statement. One, so I know where I should be at the end of the period. Okay, what should be my net income? What should be my expenses? What should be my revenues? And likewise, too, the shareholders are going to demand this from you. Companies many times will publish their pro formas, and the shareholders will hold them accountable. and the price of stock will go up or down depending on did they achieve their budget or not. If they did better than their pro formas, the price of stock will go up. If they didn't do as well, if their performance is less than that, then the price of stock will go down. Now, also, too, you need to prepare a capital expenditure, and that is, okay, if we're going to have to buy some new equipment, that's going to require cash flow. We need to budget for cash. We don't want to run out of that. That's an important element here, especially if we want to maintain a certain minimum cash balance. A budgeted balance sheet, maybe. Usually investors aren't quite as concerned about that, but they may be concerned in terms of the amount of liabilities that you have. So again, kind of in a conceptual point of view, here are the steps. And as I said, the problem that I gave you dealing with a snowboard problem will take you through step by step by step. There's a rational reason for doing it this way. We're building all the pieces which then go into the pro forma income statement, the pro forma balance sheet, okay? And then likewise too, the second part of the problem that what you'll look at is preparing the cash budget. And that is, will I have to borrow cash because I'm short cash? Or will I have excess cash in which I should invest it? And I need to be able to anticipate that so I can negotiate with the bank to have a line of credit that I can borrow when the time needs, or have an agreement with a brokerage firm or something like that, so that when I have excess cash, I can invest it. Now, sensitivity analysis is just simply saying, okay, we built our master budget. Now let's go back and take a look at some what-if situations. What if the cost of materials went up? What if the sales price changed? What would happen with all of that? Okay. So those are elements that are going to be important in building this budget. Okay, so based on our original model, we can look at some worst case scenarios or best case scenarios and be able to sort of say, well, if this happens, we've kind of looked at it, this is what we're going to do, both on the positive and negative. And so it's a way that companies can run some simulations so that they're ready if, as I said, if the best happens or if the worst happens. They're ready, they've looked at it, they know what's going to happen. Now, one thing that's important in terms of concepts, that is that you can have different types of responsibility centers. Generally, what we look at in cost accounting would be a cost center. That is, the production manager is generally responsible only for cost, that she or he is in charge of production, and they have no control over sales, but they do have control over, they may not really have any control over the price of materials, but they certainly do have control over the maintenance of machines, the scheduling of labor, and so their goal is to achieve a certain level of production. That's going to be important, and at the budgeted cost. A revenue center is a little bit more unique. A revenue center would be like operating a website to solicit sales, and so there's really no cost per se, or we kind of assume the cost is not really relevant, and so they're just going to be judged on the total amount of revenues. More is better. Now, a profit center combines both 1 and 2. And the idea here is that the manager has control over both revenues and cost, but has no control over capital expenditures. An investment center would bring all of those together, saying that the manager has control over revenues, cost, and capital expenditures. So this manager would be based not on profit necessarily, but on a return on investment. And so those are the metrics by which we would judge how well a manager is doing. Okay, we'll come across this term a little bit later in another chapter, variances. Variances are simply the difference between what we budgeted for and what actually happened. So if our sales are greater than what we budgeted, it's a variance, but it's a sort of a favorable variance. If our sales are less than what we budgeted for, it's a variance, but it would be unfavorable. I can do the same thing with cost as well. And it's a way of looking at and deciding, are things working the way that they're supposed to be, and what kind of corrective action do we need to take? You know, it all comes down to responsibility. Who's in charge and who is responsible? And who is going to, who should have controlled the process? Who did control it or who should have controlled it? So that's really what responsibility accounting is about. And so the idea too is that if I'm a production manager, I am responsible for controlling costs, but I really don't have any control over capital expenditures. I have no control over revenues. So the idea is responsibility and controllability need to go hand in hand. Don't make people responsible for things in which they have no control over. All right, that pretty much sums up the general concepts regarding master budget. As I said, to look at the actual application, which is probably what you're more interested in at this point, in being able, excuse me, to do the homework. Take a look at the homework discussion I put out there for Master Budget, where the problem takes you through step by step by step. And as I said, budgeting is one of those things you have to see, you have to do in order to be able to understand it. It's not something that you can just say, well, here's some general concepts, go out and do it. So take a look at that, and I think it has a pretty good explanation of how, when, and why you do what you need to do to create a budget.